What is your thoughts on it?
Here's the standard I'd measure any premium finance against. There is a standard at which you say this is a healthy premium finance strategy. And that standard is, can the client write the check and choose not to? That's one. Probably fails on Kaizen. I'm not super familiar with MPI, but if it's anything like that, probably fails there, maybe. Is the client servicing interest? Kaizen, they're not. Can we exit the bank in a reasonable period of time, whether or not we choose to, and whether or not interest rates do what we think they do? Probably not. So these are some things that when you have an ultra wealthy family that's doing it for estate planning purposes and they're not doing Kaizen, first off, because they're going to make sure that these things are in place. They understand their guarantees. They understand their collateral. Collateral is a big thing. Those moving parts affect collateral. Do you understand how that works? Paying first year premium out of pocket and then financing afterwards does not really expose you to potential collateral risk. It's kind of pitched as though it takes it off the table, but that's not necessarily true if all the other assumptions are wrong, such as crediting rates and interest rates. Going back to, these are the moving parts. So anybody that's involved in any sort of premium finance strategy, no matter how it's projected, has to understand all of those moving parts, how they affect each other, what happens if they go a different direction. I don't care what the historic 30-year marker of arbitrage is. It's not an arbitrage play.
Talk to me about that, because that's what a lot of premium finance way is sold. Is like you're borrowing from the bank here and you're going to make over here, and it doesn't take a genius to run the calculation about arbitrage. And yet I wouldn't feel comfortable at all, even with IUL projecting arbitrage. The fact that you may get arbitrage in a few years, and that's great, but if your whole plan is built around arbitrage in insurance,
and it's not guaranteed. That arbitrage is not guaranteed. We know it because we live it right now. So just to define for the audience what you're talking about and what we're talking about on arbitrage is this idea that we're going to be able to borrow, because over the last 30 years, going back to when LIBOR came into existence, I think it was 1986, and tracking, a couple big mutual companies and their whole life dividends, we see a trend that there's about a 2% difference between LIBOR, which is now SOFR, replaced with SOFR, and crediting rates.
You'll have to explain what LIBOR and SOFR.
LIBOR and SOFR are just these, it's London interbank overnight rate, and SOFR is the replacement for that. And I'm not going to have the acronym off the top of my head, but it's essentially how banks are borrowing money and transferring things together. And then how a lot of our borrowing rates are based on prime.
Yes.
So everybody's familiar with prime. SOFR is just a different version of that, but it's settled every night.
Yeah, so you're saying that
there's an overnight rate, there's a 30-day rate, whereas prime is updated a lot.
You're saying that cash value growth is over time going to be 2% lower than what you could borrow at.